Picture this, it's 1923 in Germany. You walk into a cafe, order a cup of coffee. The waiter tells you it costs 5,000 marks. You order a second cup. When the bill comes, 14,000 marks. Why? Because in the time it took you to drink that first cup, the currency lost half its value. This actually happened. And you know what didn't collapse? Gold. Today, we're diving deep into one of the most fascinating financial phenomena in human history. Why gold survives every single economic crisis, while paper money crumbles time and time again. And trust me, what you're about to discover will completely change how you think about wealth. Let's rewind to 2008. The entire global financial system is imploding. Lehman Brothers, one of the oldest investment banks in America, files for bankruptcy. Stock markets are in free fall. Real estate is tanking. People are losing their homes, their jobs, their entire life savings. It's complete chaos. But here's what's wild. While the stock market crashed 49%, gold did something incredible. It surged 47%. Think about that for a second. Everything traditional investors thought was safe, stable, secure, gone, wiped out. But gold? It not only survived, it thrived. And this wasn't some random fluke. This is a pattern that repeats throughout history over and over again. Let's go back even further. The Great Depression. Between 1929 and 1932, the US economy contracted by nearly 30%. Unemployment hit 25%. Banks were failing left and right. But during this same period, while paper assets were becoming worthless, gold held its ground. In fact, when President Roosevelt devalued the dollar in 1933, redefining it from 1/20th of an ounce of gold to 1/35th, those who held physical gold actually saw their wealth protected. Here's what's fascinating. Every single major recession since 1970 tells the same story. In 5 out of 6 major economic downturns, gold prices increased while everything else decreased. During the early 1970s recession, gold jumped 87%. During the dot-com crash of the early 2000s, while tech stocks were getting obliterated, gold quietly rose 11%. And during the European sovereign debt crisis, gold surged 31% in just the second phase alone. But why? Why does this happen? The answer lies in understanding what money really is and what it isn't. Paper money, what economists call fiat currency, has no intrinsic value. It's literally just paper. Its worth is entirely based on government decree, on collective belief, on trust. And here's the uncomfortable truth that most people don't want to hear, that trust can evaporate overnight. When governments face massive debts and deficits they can't control, they have one easy option: print more money. And they do, constantly. Gold is different, fundamentally different. It's a physical asset with intrinsic value. It's scarce. You can't just create more of it by printing. For thousands of years, across every civilization, gold has been recognized as valuable. It's been used as currency, as a store of wealth, as the ultimate safe haven. And that's because it has properties paper money can never replicate. Let me paint you another picture. Germany, 1922 to 1923. Hyperinflation. At the beginning of 1922, you needed 300 German marks to buy $1. By January 1923, 49,000 marks. By July, 1,100,000 marks. By November 1923, 4 trillion marks. The currency didn't just lose value, it became completely worthless. People were using banknotes as wallpaper, burning them for heat because they would burn longer than the firewood those same banknotes could buy. But here's the kicker. During this entire catastrophic collapse, if you measured the price of a meal in gold, it stayed stable. A full lunch with coffee, beer, and dessert cost about 25 cents in US silver coin in 1920. in 1923 at the peak of hyperinflation, still 25 cents in silver. The purchasing power of precious metals remained constant while paper marks became toilet paper. The same pattern played out in Zimbabwe in the 2000s. The inflation rate hit 6 billion%. 6 billion. The local currency became so worthless that people abandoned it entirely, switching to US dollars and South African rand. And gold? Its price in the local currency exploded, reflecting the complete destruction of the paper money system. Venezuela, more recently. In 2018, inflation reached nearly 1.7 million%. People were literally playing video games like RuneScape to earn virtual currency that they could sell for real money because they could make more doing that than working actual jobs. The Venezuelan bolivar became so devalued that vendors were making shopping bags out of the worthless currency. But those who held gold, they preserved their wealth. Now, here's what's crucial to understand. Gold isn't just about hyperinflation, it's about any crisis. During the 2002 recession, stocks fell 24%, gold rose 11%. During the global financial crisis starting in 2007, as the world's financial system teetered on the edge of complete collapse, gold nearly doubled in value over 5 years, going from $825 per ounce to over $1,650. Even during Brexit in 2016, when global markets were panicking over political uncertainty, gold demonstrated its stabilizing force. During the COVID-19 pandemic pullback in early 2020, while everything was crashing, gold was surging. By April 2025, gold reached $3,499 per ounce, up from $1,575 at the pandemic's start. And here's the thing most people miss. Gold doesn't just protect you during the crisis itself, it protects you during the aftermath. Because what do governments do after every crisis? They print money, massive amounts of money. Quantitative easing, stimulus packages, bailouts, all of that new money flooding into the system erodes the purchasing power of the currency you're holding. But gold, it maintains its value precisely because they can't print more of it. Between 2008 and 2012, as the Federal Reserve ramped up quantitative easing programs, the producer price index for gold increased over 100%. Why? Because investors understood that all that newly created money was going to devalue the dollar. They sought protection in something real, something tangible, something that couldn't be conjured out of thin air by central bankers. Let's talk about interest rates for a second because this is critical. During recessions, real interest rates often go negative. That means after you account for inflation, your money in a savings account is actually losing value. When this happens, gold becomes even more attractive. You're not earning anything keeping your money in a bank anyway. So why not hold an asset that has thousands of years of history as a wealth preserver? Central banks understand this, by the way. That's why they're buying gold like crazy. For 3 consecutive years, central banks worldwide have purchased over 1,000 tons of gold annually. These aren't amateur investors. These are the most sophisticated financial institutions on the planet, and they're stockpiling gold because they know what's coming. Current US federal debt exceeds $35 trillion. Deficits are running at wartime levels during peacetime. The same dynamics plague Europe, Japan, and emerging markets. When governments accumulate debts they can't possibly repay through normal means, they resort to currency devaluation. They inflate away the debt by making their money worth less. And when that happens, gold protects you. I'm not saying gold is perfect. Its price can be volatile in the short term. During the initial panic phase of the 2008 crisis, gold actually dropped 28% as investors sold everything to raise cash. But here's what happened next. It surged 78% over the following 2 years. Gold dropped briefly during acute panic, then rallied powerfully as central banks responded with monetary stimulus. The lesson: gold isn't a get-rich-quick scheme. It's wealth insurance. It's what you hold to make sure that when everything else fails, you still have something of real value, something that will be recognized and accepted anywhere in the world, regardless of what happens to any particular government or currency. Throughout history, from the fall of Rome to the collapse of Weimar Germany, from the Great Depression to the 2008 financial crisis, one pattern remains constant. Paper money fails, but gold endures. Governments come and go. Currencies rise and fall, but gold has maintained its purchasing power for over 5,000 years. So here's the real question. In a world drowning in debt, with governments printing money at unprecedented rates, with geopolitical tensions rising, with economic uncertainty, everywhere you look, can you really afford not to own gold? History has given us the answer again and again and again. The only question is, are you listening?